The world is clearly entering a new phase. Every central bank will fund their entire budget deficit, creating helicopter money madness. Meanwhile, the average know-it-all retail investor has been pushing pedal to the metal on leveraged stocks, singing the tune, "Print for me, Powell," all day long. But there is no certainty in this game except that humility is a good trait to have. You came here for the truth, so let me unveil that for you. Today, we're going to look at what's been happening with the central banks. I'll talk about the Federal Reserve. I'll give you an update on that. We're going to look at what Jerome Powell said specifically. I'm going to talk about the real estate market as it relates to commercial real estate. I'm going to show you what's happening in the unraveling process there. I'll show you Toronto in the residential markets. I'll give you some updates on that because it is an extreme. It is the biggest bubble in the world as far as I'm concerned. And then we also will look at a few other things. I've got a lot to get into, so let's begin right away. Real estate owners in the wake of the 2007-2008 financial crisis who opted not to fight to keep their homes or commercial properties instead sent back the keys to lenders to sort out the mortgage mess. You've probably heard about this before. You may have known somebody that had this, dealing with this issue, and it is occurring today right now as we speak on the commercial side. Of course, it's been going on the entire time, but it's starting to accelerate, and there's some very prominent companies here that are involved. So check this out. Simon Property Group is the largest U.S. retail real estate investment trust, REIT, and shopping center operator. Recently took some similar actions on 4 of its struggling shopping malls that have $410 million of mortgage debt. Now, I know there's going to be people out there who will say, that's only $400 million of mortgage debt. Look how much mortgage debt there is. You got trillions of this stuff out there. You divide the two, small number, I'm moving on. Well, of course, when you look at it like that and not actually see the bigger picture, not actually connect any dots, of course you can do that and simply go off and buy 7 shares of Amazon, check out a couple cat videos on the way out, and you will find yourself in a state of bliss. But instead, we can look into the reality of the situation that's going on. The mall owner indicated it would engage in a, quote, friendly foreclosure of this particular mall, and another one that they're mentioning here in monthly property reports to the bond investors. Now, this just shows you that it is happening systematically. It is taking place, and it's not just Simon Property Group. Of course, there are others. And at the bottom here, it's just saying it will reveal that it will no longer inject capital into this particular mall. It's going to, have some other problems at other places. They get into the details further along in the article. I'll show you some of that. But all I wanted to highlight here is the fact that it's not just one mall. It's not just part of the U.S. It's going on all over the place. Wherever we have retail, wherever we have office space right now, we've got problems. Retail properties and hotels have been the hardest hit commercial property types by the global issue of today, of 2020. First, by mandatory orders in March by state and local officials to temporarily close businesses, but also by the surge in online shopping in subsequent months that cut property cash flows, as well as other stresses in 2020. So there was a trend, of course, that we see with online shopping. Just prior, I would say beginning of the year 2020, we had approximately 10 to 11% of all retail, and that was the numbers that I pulled up, official data as well as unofficial data, showing you the same thing. 10% to 11% of all retail. That actually accelerated, it boosted up, and I haven't got new numbers on that, but it is quite high because people's buying patterns had to change rapidly. But this basically, what that did was it put additional pressure on those places that, maybe 5 years from now would have had their crisis, would have had to deal with it eventually. So this is just accelerating that trend in a very, very rapid manner. There's no doubt about it. While characterized as having operational expertise and deep brand relationships that support quality tenant rosters, SPG is not immune to the adverse effects of the crisis of 2020. The properties here deteriorated significantly since the mortgage debt was originated. And of course, we have this issue. There's going to be many more that come up. To that end, the team identified another nearly $1 billion of debt on Simon malls that are categorized as a high credit risk due to falling cash flows or other financial metrics that point to potential stress. So understand where there isn't that money coming in. Previously, these malls that you see, understand that they all have some sort of debt that's behind it. This particular debt has basically there's a lender in here somewhere, a bank, some sort of lender that is making sure that that happens. And if one of these portions of this mess have a problem, of course you are going to have an issue and it's going to circle back. This is something that we need to understand. When it's not just the mall, it's not just the store, it's not just that business, it is the whole financial system itself. And that's why I keep harping on it. And I know that there's some people that are not happy about this, but I have to continue to talk about it. It is so critical. Canada's office market takes the biggest hit in a decade. The office market in Canada's major cities experienced its largest negative quarterly net absorption in more than a decade during the third quarter of 2020, totaling nearly 2.7 million square feet of occupancy losses. The national vacancy rate rose by 60 basis points to 10.8%. Now that's big because there's a lot of money riding on this. If you look across Toronto, the most cranes out of any city, and you don't see that as a problem, well, you don't have to look too far to see the prices of residential real estate, which have risen tremendously recently. Everybody is buying left, right, and center, and I'll show you the data on that. But specifically when we talk about office, when we talk about retail, basically most major cities right now are taking a hit. They're either soft markets or terrible markets. They get into the details if you want to see them all, but I think you get my point. This just gives you a highlight of what's been happening in Toronto, and it's an extreme case, that's for sure, but I know that a lot of other places are dealing with the same thing. The Toronto real estate market is truly a crazy place. At the same time that we are seeing rental properties literally giving away months of rent for free, we're also seeing record-breaking highs in home sales. That's right, for the fourth month in a row, Toronto has seen increases in home sales across the board. The numbers are coming in from the most recent report, and they're saying that Toronto is up 25% from sales in October 2019. And that just shows you that there are two different worlds that are happening today. And why is this the case? Of course, you got the work from home people. People are moving out of the urban centers into the more suburban environments. This is taking place with people moving from Manhattan into, let's just say the more spaced out areas. Maybe, this is looking at what you would call cottage country in different cities. I know you're dealing with the same thing wherever it is that you are from. People are going out, they're looking for places that maybe where they could have dealt with a 3-bedroom home. Now they need a 4th bedroom because they've got 2 people in the house. They need to work out an office situation and so on. This is all news that I know you are aware of already. I'm only highlighting it to show you that this is taking place not just in New York City, but it's going on all over the place. That's basically what they say in this top paragraph here, just showing you that people are moving out of the urban centers because they can work from home. And then at the bottom, they said something that was so unbelievable, and it's so typical of Toronto. And let me just read it to you. Essentially, though buying a house in Toronto, I'm going to be laughing here in a second. I know I can't control it. Essentially, though buying a house in Toronto may still be completely unaffordable, and there is a caveat here, if you've at all been considering moving from your current situation to another rental in what has traditionally been one of the costly cities in which to live in the world, now is definitely the time to do so. Yes, it's completely unaffordable, but you should do it right now. That's the media and the way that they treat you. This is unbelievable that they just do this over and over and over again. And honestly, I just can't handle it. This is the data that corresponds to this. If you are interested, it's here for you. I'll put it up. It will be in the description as well. So take a look if you want. Nobody really knows how many jobs will be lost in the end. I know a lot of individuals that are quote unquote furloughed, but they haven't actually been laid off. They're not coming out on the statistics. And we can only deal with forecasts and surveys and look at some government data and try to piece it all together to give us a good idea of what's been happening. But this is interesting. US looks set to lose 9.2 million jobs in 2020, and that is quite significant when you see this because that's permanent. That's not they lose a job for a few months and they're back to work. No, not at all. It is essentially that the jobs will not be there. They will have to get another type of job, but will the employment be there in some other field that somehow they have to be ready and prepared and trained for? So this is something that I just wanted to bring to you because it just highlights the severity of the situation that we're dealing with. Jerome Powell had a few things to say. I just wanted to touch on a couple here. Quote, "We're not going back to the same economy," Powell said. "We're recovering, but to a different economy, and it will be one that is more leveraged to technology, and I worry that it's going to make it even more difficult than it was for many workers." The central bank leader said he was referring specifically to relatively low-paid public-facing workers who are bearing this brunt. This is something I talked about many, many times, of course, highlighting essentially what we were speaking about a little while ago. And, you know, there is a lot here and there's a lot of fluff around it, but he's highlighting the point, and that is the recovery is not going to be everybody gets their job back, everything is so nice. It's going to be that K-shaped recovery that we have talked about before. Those people are going to struggle to get back to work in their old jobs, or in many cases new jobs. So I think you'll see more telework. You'll see probably the acceleration of automation. All of that was in the process of happening, but you're going to see much more of it. Exactly what I've highlighted so many times before, how we are seeing this acceleration of automation technology that is coming on, and it's displacing the jobs too fast for people to come in. It's not happening over a generation. I see this silly comments saying, you know, why are we going backwards? And, you know, it's not the way it works. It's not as if we're going from trains to cars. That didn't happen over the course of 2 years. It happened over a longer period of time so people could adapt to it, right? And both of them were operating simultaneously. The horse and buggy, right? You had both of them simultaneously. The first people, the ones who were more wealthy, they could afford these new technologies, they adopt it first, and then it becomes mass produced, and then others can afford it and so on. But that's not happening today. It's accelerating too fast, and it just puts a lot of people out of work. That's all I'm trying to point out. Whatever, you know, your opinion is, my opinion doesn't matter. I'm simply pointing out these facts. The Federal Reserve's balance sheet has expanded once again, and I just wanted to give you a little note. By the way that they're showing the recession here is a strange color. Normally it is a dark gray color. I don't know if they're just changing the website or they're making it to be something else, but anyway, it doesn't matter. I'm just showing it to you here, and it is just about at the highest it's ever been. I think it was previously a few weeks ago, like just a touch higher, and then it came down and now it's back up. So the trend is on the way back up again, as it is, and as they said that they want to expand their balance sheet as much as humanly possible. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. Simply by clicking one button, you support this channel. Thank you. Learning how to sell online, understanding e-commerce, that's a skill. It's a skill that you should have, particularly as more and more jobs get outsourced and automated. If you want to learn actually for free, you don't want to pay anything, you don't want to pay a $1,000, $2,000, whatever the course fee is, you can get started right now today at my website, theamazongps.com. The financial system, it's difficult to understand, and they do this on purpose. They make it impossible, essentially, for us to try and connect dots. But if you want to know everything that there is and just have that ability to ask the right questions, to dig into the right materials, these two books will give you everything that you need. Check it out at the link in the description. If you want the audiobook instead, you can get that at themoneygps.com. Wait a second, don't go anywhere. Have you seen this video? Definitely a lot of information to check out. Click it, I'll see you there.